Please note that the information on Retire Vivid referenced in this video is accurate as of May 17th, 2024. Changes to laws and regulations may make portions of this segment outdated and no longer relevant. Information presented is for educational purposes only and is not intended to provide investment, tax, or legal advice. Please see our full disclosure at the end of this video.
Welcome to Retire Vivid. I'm McCarty. That's Tommy Breitbach. We're both financial advisors, and today is how to structure and also how to invest your portfolio in retirement. So we got a good segment for all of you today. Tommy, we work with a lot of people that are retired or close to retirement. That's our client, right? And they've worked extremely hard to get to their point, and most of their wealth is either in their home or their 401k IRA. But when you're building these plans for people, a lot of clients, they want a decent rate of return. They don't want to lose a lot, right? Which makes sense because when you're working, you're feeding these 401k plans. But when you retire, what we have is what we're walking into retirement with us. So that's why it's so important to be taking a look at your risk, the emotional end of investing, all of that, and why you work with an advisor.
As somebody who's starting out investing, your goal is to accumulate and see where you're at in 20, 30 years. But it is a big decision as you're 5, 10 years away from retirement, just deciding, okay, here's where I'm at, here's where I may be at retirement, what does retirement income, investing, all those things look like. So it's really important to just assess kind of where your financial situation is and also the emotional aspect you feel about investing. So right there from the SEC glossary of terms, it says risk tolerance is an investor's ability and willingness to lose some or all of an investment in exchange for greater potential returns. So your safer investments, tend to return less. Your more risky investments tend to return more, but it also comes with more downside. So the important piece within that being two components, the ability and willingness. Ability is kind of the financial situation. So what is your, income sources? What sort of income need do you have relative to your portfolio size, withdrawal rate?
Right, which is helping build that plan and looking at all those other variables that go into your retirement plan, because money is a means to get us somewhere, right? So that's ability, but also it's the willingness as well too.
Yeah, and that's the piece that, working with an advisor or depending how you feel, that's the piece that you can help from the emotional end.
The emotional,
and that's how you feel about investing. Do you get really excited about gains or really worried about losses? Where do you fall across the spectrum? Do you understand markets go up and down and tend to go up over time, or is it a real worry when it's down? And so that's the important part to figure out as you enter retirement and you are living off of those assets.
Well, exactly. Because all of our viewers and also our clients as well too. We all do, and all advisors do a risk tolerance questionnaire. And I get it. Okay, here's this number, but it doesn't talk about the emotional end of it, right? How much emotionally can we stomach? And we're going to talk about that because once again, a lot of times these people are fueling those 401k plans, and that's all they're doing. They're not really looking at it. Now they spend a lot of time on it. So, for example, when the market is struggling versus, when the market is on fire, to your point, how do you react to that? That's why it's so important to stay the course in terms of the plan that has been set out for you or the plan that you've done yourself.
It's really easy when the market's down to say, I can't take anymore. But then you don't, depending how long you're out, what time you're out, you don't get that return coming back. Or, when the market's on fire, if you're in let's say a moderate type portfolio, you look at the news, you see the S&P every day. You feel like you're missing out on something.
You probably shouldn't do that.
Well, not every day. But you
don't do it every day.
But you feel like you're missing out on something. So it kind of leads to that chasing mentality. Yeah. And that's where, just depending where you're at, but timing mistakes can happen.
Well, let's just stay on that for a minute and talk about your risk capacity, Tommy. And let's talk about throughout the years, just to give our viewers a little bit of a visual aid, if you would.
Yeah, so this was an example from Schwab, and they said, over the last 5 periods from 74 through 2022, when the index or S&P fell by 20% or more, what happens if you stayed fully invested through the bear market, or if you moved into cash kind of at the lower end of that for different periods of time, kind of what it does coming back from that. And so it shows, over time, 1 year later, 2 years later, 3 years later, it tends to be how much better you're off by having that plan, sticking to that, and kind of riding out or weathering the storm per se.
Well, yeah, that's such a great chart in terms of just to give our viewers an idea of what that looks like. So now let's talk about staying the course. This is a big one because it is always important to reassess your risk tolerance because it changes over time, right? Meaning that when we're younger, we're in that wealth accumulation phase where you're building, fueling, feeding. And then as we get closer to retirement, that's the mental thing that messes with people is they're so used to that. Now they're moving into the distribution phase of their overall 401k because now they're going to start living on it. So Tommy, let's talk about this because again, let's just stay on the emotional end with people because the first one is how much can I stand to lose emotionally?
Right. Everybody, educating on the investment side is going to say, look at the long term. Right. The long term happens over the long term. It doesn't happen in any given 3, 6, 12 month, 18 month period. And so it's really important that you figure out, what allocation makes sense to you. What type of, return number are you looking for kind of relative to a potential drawdown or a potential loss in any given, any certain period of time. And so sure. As you move from, we're looking at this, conservative, moderately aggressive, and aggressive. And it's showing kind of the allocation to stocks. So stocks compared to bonds tend to be more volatile, more potential gain, but also, more downside in the interim.
Sure.
And so as you move up that spectrum, it's, you can see that you have the potential for a higher best year, but the piece that scares people tends to be, the lower worst year. And that's where mistakes are made, where if you're not aligned, if you're not emotionally aligned to how you're invested, kind of mistakes are made at the wrong times.
And that is why we do that risk number. I talk about it a lot during our episodes, meaning that what is your risk number? Because, again, as an investor, the sky's the limit. You can invest in anything you want to invest in. The question is that the right investment that you should be in? So we want to know what that risk number is. For example, let's say that you have a risk number of 40, right? But your portfolio is at a 70. Well, you'll be happy, just like what you're showing here in terms of an up year. But when the market turns, you really won't be happy. But then let's flip it. Let's just say you've just never been happy with your portfolio, and you have a risk number of 70, but your portfolio is at a 40, and you've just never been happy. Well, no wonder it's not getting up there with you. It's so you want to align that. And that's also, Tommy, I want to talk about this too in terms of average annual returns when you look at a conservative portfolio, when you look at a moderate or moderate aggressive portfolio. Let's talk about that.
We've touched on this, and it's the long term, and the long term happens over a period of years. So it's really important to understand, there are going to be the kind of, we'll call them the emotional time periods over 6, 12-month windows. But, for most people retiring nowadays, you're looking at a 15, 20, 30-year retirement.
Hopefully.
Yeah. And so it's really important that you kind of keep the long term in the back of your mind, but stay kind of near term aware.
That was pretty good. Okay, that's a good segue to a commercial. So, okay, we're talking about a lot here. So stay with us because next we're going to talk about how to structure your portfolio. This is a good one right after the break.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Welcome back. If you just joined us, we're talking about how to structure your portfolio. And we've also talked about investing a little bit in terms of guidance, if you would. Now, Tommy, what I want to do is that structure, the bucket approach. I mean, that's something you and I, do a lot of. And so let's just start with putting aside, at least 1 year of cash. We need to make sure we have that, especially during retirement.
Right. And real quick, and getting into those numbers. So, different episode, different time. But
different deal.
It's having the plan, having the budget.
Yep.
It's really important. So if you're looking at, in retirement, your sources of income, are you lucky enough to have a pension? Do you have,
right.
Is your Social Security on, and then what kind of supplemental cash do you need beyond, those two kind of recurring sources to get you kind of through 1 year? And those are the kind of the needs and maybe a little bit of the wants.
Well, it's also, Tommy, when you look at the first year of retirement, there's a lot going on. You know what I mean? Sometimes you retired and maybe you're waiting for a severance package, for example, that in terms of, what you may have received from the employer. Maybe you're waiting from a 401k distribution. Maybe you're waiting for Social Security. That's why you have to have this, because you don't want to feel like you're in a pinch waiting for something to come in.
Right, and it's having, keeping the lights on, eating meals, the real important stuff, kind of having that 1 year of supplemental income for cash. Your second bucket is getting into the larger ticket items or something you may need over a shorter window.
A short-term reserve fund.
Yeah, a short-term reserve fund. So maybe something you're going to need over the next 1, 3, 4 years.
Like
kind of
a car.
Whatever it may be.
Like a car.
Yeah, life happens.
Yeah.
You run into,
Life does happen.
You need a new roof. You need that new car.
Yep.
You want to take the big trip or something. You retired, you're planning that big trip. But you have that in, kind of the short term. So you have CD options, short-term bond options, just different things, but keeping some liquidity there. And that's also really important to have a cushion there to access. We'll get into, timing, how important timing is later.
Yeah, right.
But that cushion to access, especially early in retirement.
And notice, we didn't even talk about investing yet. We want to make sure you have those reserves and also those buckets of money, if you would, for any big ticket items that may be coming down the road. Taxes plays a big role in this as well, too. We did just an episode on taxes, and so let's move on to the next. You move and you invest the rest, and once you have these, this bucket approach designed.
And investing the rest. And it's really important. That first segment we spent so much time talking about, the long term versus what happens in that short term. So you fill those first two buckets up. That gives you, kind of some reassurance or, hope that you're going to get through those first 4 years. You got the reserves you need, and then investing the rest. And if that allows you to kind of look over the long term and weather those market downturns, or seek to be maybe higher growth with those assets, it helps with the retirement plan a lot.
Let's put this into perspective, Tommy. This is some good stuff right here. So again, folks, if you're listening, this is some good stuff that we're going to talk about here. Tommy, I want to talk about an example of two different type of investors. Now, what we talk about is a withdrawal rate, right? A withdrawal rate of what you're pulling out of the portfolio, right? Because we don't want to see the account erode. That's not what we want to have happen here. So Tommy, walk our viewers through this example, because timing does matter when it comes to withdrawals from your retirement plan.
Two investors both start with $1 million and have in that first year 5% withdrawal rate, being $50,000 income need.
Yep.
That income increases 2% a year for inflation. So this just highlights how important that sequence of returns is.
Yeah.
Very early in retirement, investor one, they lose $15% that first year.
Decline, right?
And it is
in the first 2 years of retirement.
Yeah, and it just 15% decline first 2 years. It just shows how hard it is to come back. Those showing the portfolio assets run out in year 18.
Yeah.
Whereas that second one was taking income. The portfolio was growing at 6%. For those first 9 years, I guess.
Yep.
They're able to kind of hang in there with their withdrawal rate and then take that decline. And at year 18, there's still portfolio assets. And so that's
a big deal.
It just highlights the importance of that bucket approach. If that market, especially early on, is down, you have those assets available to access. That is not the investment portion. You're not selling kind of at the bottom or at a low.
So let's take the same investors, Tommy. We got 1 and 2 here. And now they're scaling back, okay? So let's talk about this one because, again, what they're doing is they're changing their withdrawal rate. So let's walk our viewers through this one.
The same 2 investors started out at $1 million, had that 15% decline in the first 2 years.
And they both experienced that.
Yes, and investor 1 made a change to their income need. Investor 2, I guess they changed as well, but just less. So in the first example, there was a 5% kind of consistent withdrawal rate. In this one, investor 1 was able to go down to a 2% withdrawal rate, whereas investor 2 was able to go down to or just decreased a little bit to that 4% withdrawal rate. And you can see, over that 20-year period, investor 1 was able to recover based on the lower income need compared to investor 2.
I mean, that says it all. I mean, folks, if there's anything good that you're getting out of this segment right now, it's beware of your withdrawal rate. Because again, when you're withdrawing from your overall retirement plan, that's that withdrawal rate. That's what you're pulling out of it. So again, we want you to have a wonderful retirement, but we also want your money to last as long as you do. So stay with us. We got some more coming your way, but before we do that, I also want to make sure that I hope people take advantage of our 15-minute retirement review. Because once again, I mean, a lot of people are calling in and they want to say, hey, Cam, am I on the right track? Is my Social Security in terms of when I take it? Tommy, there's a lot of things that people get some good out of that 15-minute call.
Yeah, it's, a lot of times we have those quick questions or maybe the more in-depth ones, but you can get through a lot kind of in 15 minutes and, just looking for that peace of mind, looking, I'm making the right decision or I have the right plan in mind as I'm, nearing entering retirement.
So next we're going to talk about the emotional wave of investing. Stay with us after the break. Welcome back. So we're talking about the cycle of emotions when it comes to investing, but more importantly, sticking to your plan. And I got some good survey here, or a really good survey that I want our viewers to see. Tommy, walk them through this in terms of the feedback, in terms of people that look at their accounts monthly versus annually. I mean, this is some good information.
Yeah, it's individual client specific, and it's how you feel about looking at your account or looking at investment returns. So there's been several studies, but one of them was a study done on professional traders, and a segment of them received monthly feedback on how things were going, gains, losses. The second segment received that annual feedback. Mm-hmm. And what they found was the results tended to be better for those who received that annual feedback compared to those who received the monthly feedback. Yeah. And also the willingness to kind of take on that risk. It shows the discrepancy in their investment allocation between stocks and bonds. And what it highlights is if you are somebody who, everyone has an emotional attachment to money. It's very important. It's your assets.
It's natural.
You worked hard to save them. But it kind of highlights the long-term versus the short-term noise and staying focused on that long-term. If you're somebody who, sees a down on your monthly statement, your account's down on a monthly statement, you may be better off just not looking at it.
Well, that's true for a lot of people because, you said it. I mean, it's natural. When you see something getting hurt, what do you want to do? You want to save it, right? You want to bring it into the boat. But this is such a great chart because this is gonna happen forever. I mean, because the human element kicks in, right? I mean, it's just funny how you look at this in terms of for people that watch it all the time, more and more bonds keep getting increased versus people that look at it yearly. But it's funny because the people that look at it yearly tend to have more money.
tend to have the better results because
results.
They're not worried about what happens in that, the short-term time period.
Because, and here's the thing too, when you hire a professional, what are you paying them to do, right? Grow your money. I mean, that's the objective of the advisor. But let's stay on the emotional wave of investing, Tommy. We talked about this. Yeah, I'm sure you remember the episode we did. It was the 10 investing mistakes, right?
Yep.
Tommy, you said something during that time, and you said you can't control the wave, but what can you do?
You can learn to surf.
You can learn to surf. So I love that.
We put that in kind of the context of when mistakes are made.
Right.
So you never know exactly where you're at, but somewhere along the line, the market's doing well, you're optimistic, you're excited. At that point, you kind of get to the
point of maximum risk.
The maximum risk, the
Wheels
euphoria,
come off
the euphoria element. People get into that chase mode, or they feel like they're missing out on something.
Right.
You make a mistake at the top.
Right.
And conversely, market turns over. First you deny, and then you get a little anxious and scared, and
fear kicks in.
Fear kicks in.
Wheels come off the wagon.
And then and then that second mistake is made is buy low, sell high.
People do the opposite.
The emotional element has people doing the opposite. You sell at the bottom, and then are reluctant to get back in. They're always worried about the next shoe to drop. That's why it's so important to stay committed to the plan.
Yeah, that's a good point. I mean, because, we just talked about the sequence of returns. We also talked about the withdrawal rates as well, too, in terms of what decisions you make over the last 1, 2, 3 years. Again, I just can't. If you want to do it yourself, good for you. I mean, as long as you can take the emotional attachment to money out of it. Because if you can be a really good investor. You really can be. Now, if you can't do that, that's where an advisor comes in. But Tommy, let's talk about the importance of where an advisor can provide value, in terms of what they can do for their clients. And so this was a very interesting segment that you brought in here. Vanguard's Advisor Alpha Strategy, which I thought was interesting in terms of how an advisor can provide value to their clients.
Yeah, and this is something that's pretty easily, it's a good size article. You can find it, Google Vanguard Advisors Alpha. But it puts out the different ways that advisors can add value to that client relationship. Those different things from, a suitable asset allocation. We talked about risk tolerance, risk profile, those things.
Tommy, I like this one. Behavioral coaching.
And that one, it talks about a number of things, that behavioral coaching piece. And what they did...
Spending strategy.
Spending strategy, if you're in RMDs first and then touching different assets later, but making sure you're accessing that IRA traditional asset first. But the behavioral coaching piece I thought was pretty interesting. And what it did, there was a study in there, and it compared the returns that investors received across a whole bunch of different mutual funds and ETFs compared to what the funds stated as their performance.
What a great chart.
So they compared what they called the internal rate of return, that's the return investors received, compared to the time-weighted rate of return. That is what the fund posted as its performance.
Got it.
And you would expect some small discrepancies in there because, people are adding money to an increasing market, 401k contributions, or, adding that money in, also taking money out for distributions. So you'd expect a small discrepancy in there. But what they found was that, investors tended to significantly underperform the fund stated return. And what that indicates is that, investors make that emotional decision. They're in there and they, if they're chasing or in the kind of euphoric markets, and then also selling out at the wrong times. And so you can see the graphic there on some of the different asset classes. You can see the large discrepancies, and especially during periods of market volatility. It has that the 1 year period in 2020. We had the COVID pandemic. Market was down significantly early in the year, and then responded quickly. Well, investor emotions kind of played into that, and we're out and not back in, and didn't get all that return back.
Tell me, what's the takeaway here? Have a plan, right? I mean, especially don't let your emotions get in the way.
Yeah, and if you are somebody that the emotions get in the way, that's where you can seek that outside help. You get a coach to help you get through market turbulence, all those pieces.
And that right there is why we're doing the show. So folks, make sure you tune in. We are on every weekend on ABC. We're on Saturdays and Sundays, helping you get retirement ready. We'll catch you next time right here on Retire Vivid.
Cameron McCarty and Tommy Breitbach are investment advisor representatives of Vivid Wealth Management, a SEC-registered investment advisor located in Des Moines, Iowa. Investment advisory services are offered through Vivid Wealth Management, LLC. Insurance products and services are offered through Vivid Tax and Wealth Advisors, and individually licensed and appointed agents. Tax planning and preparation services are offered through Vivid Tax Center, LLC. The preceding entities are affiliated. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Case studies and examples presented are hypothetical and used to demonstrate a concept. These studies do not represent actual clients or results. Similar or even positive results cannot be guaranteed. None of the entities above are affiliated or endorsed by the Social Security Administration or any government agency. Information expressed does not take into account your specific situation or objectives and is not intended to provide investment, tax, or legal advice. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Investments involve risk and, unless otherwise stated, are not guaranteed.